The markets are quiet, the charts are frozen, numbers are not moving. It feels calm, almost peaceful. But this calm is an illusion. Beneath the surface of the global financial system, something is breaking. And while most people are enjoying the holiday season, powerful institutions are working through the night. Lights are on, phones are ringing, emergency calls are being made. This is not normal, this is not routine, this is fear. A single commodity has triggered this reaction. Silver, one move, one sharp surge. In just one session, silver jumped violently. Not a slow climb, not a controlled rise, a sudden shock. And when a core asset moves like that, it sends a signal that something is wrong inside the system. Silver is not just another metal. It sits at the intersection of finance, industry, and monetary confidence. It is used in technology, energy, defense, and medicine. It is also traded heavily in paper markets with extreme leverage. When silver moves fast, leverage becomes lethal. This is why the alarms are sounding. This is why emergency meetings are happening behind closed doors, not because prices are rising, but because the structure holding those prices is cracking. Banks do not trade silver with their own money. They borrow, they leverage, 20 times, 30 times, sometimes more. When prices are stable, this creates easy profits. But when prices jump suddenly, losses multiply instantly. A 5% move against a leveraged position can erase an entire balance sheet. A 10% move can create insolvency. That is the reality many institutions are facing right now. When losses exceed available capital, the problem spreads. First to hedge funds, then to banks, then to clearinghouses. And when a clearinghouse is threatened, the entire market is at risk. Clearinghouses are the backbone of the financial system. They guarantee trades, they absorb defaults. If they fail, trading stops. Trust disappears. Liquidity vanishes. This is why regulators are involved. This is why central banks are watching closely. This is not about silver anymore. It is about stability. History gives us warnings. Similar emergency meetings happened before major financial events. In 1980, during the silver crisis. In 1998, during long-term capital management. In 2008, during the collapse of Bear Stearns. Each time, the pattern was the same. Excess leverage, sudden price movement, weekend meetings, rule changes, intervention. The playbook has not changed. Only the scale has. When institutions are cornered, they look for ways to slow the market. They raise margins. They restrict positions. They halt trading. These actions are presented as safety measures. But in reality, they are defensive moves. They are designed to protect those who are exposed. Margin increases force smaller traders to sell. Position limits reduce pressure on large shorts. Trading halts freeze the price. These tools do not fix the problem. They delay it. The deeper issue is physical supply. Paper markets can create infinite contracts. Physical markets cannot create metal. When demand for real silver increases, paper prices eventually lose control. This is when decoupling happens. Futures prices stay low. Physical premiums explode. The gap widens. We have seen this before in other commodities. When confidence in paper settlement breaks, physical ownership becomes everything. Industrial buyers understand this. Tech companies, energy producers, and manufacturers do not speculate. They secure supply. When volatility rises, they buy more, not less. They stockpile. They sign long-term contracts. They remove metal from the open market. This tightens supply further. Miners also respond. When prices rise rapidly, miners slow sales. They wait. They hold inventory. They understand leverage better than banks because they operate in the real world. Rock does not care about paper contracts. This creates a feedback loop. Less supply, more demand, higher prices, more stress on shorts. Meanwhile, collateral is weakening. Banks rely on government bonds as security, but bond markets are unstable. Yields are rising. Prices are falling. This means collateral values are shrinking just as liabilities are growing. This is a double squeeze. To survive, institutions sell other assets. Stocks, crypto, anything liquid. This spreads volatility across markets. What started as a silver move becomes a macro event. This is how contagion works. The media response is predictable, calm language, reassuring headlines, statements about sufficient liquidity, warnings about speculation. Attempts to frame the move as irrational. Narratives are tools. They are used to shape behavior, to slow panic, to encourage selling, to restore confidence. But confidence is fragile. People are not watching headlines anymore. They're watching prices. They're watching availability. They're watching premiums at dealers. They are watching delays and shortages. Reality cannot be spun forever. If authorities attempt to suppress prices too aggressively, consequences follow. Capital flows elsewhere. Trust erodes. Alternative markets grow. Global power shifts. Markets do not like control. They find cracks. They push through. This is why intervention is dangerous. Every action has a cost. Every rule change accelerates the long-term breakdown of confidence. The most extreme option is to restrict buying entirely. Liquidation-only trading, turning off demand. This guarantees price drops, but it destroys credibility. Once trust is lost, it does not return easily. Markets remember. If that line is crossed, global trading migrates. Liquidity moves to regions with fewer restrictions. Control is lost permanently. Authorities know this. That is why they hesitate. Meanwhile, psychology is shifting. Retail investors are waking up. Years of negative real rates have pushed savers toward hard assets. Search interest is rising. Social discussion is growing. Awareness spreads fast in digital markets, but access is limited. Physical silver is scarce. Dealers are sold out. Premiums are high. Delivery times are long. So money looks for alternatives. Mining stocks, developers, explorers. Equity becomes a proxy for metal. This is how capital flows when physical supply is constrained. Technical levels become irrelevant during stress events. When price enters uncharted territory, algorithms rely on mathematical extensions. Targets appear, momentum builds, volume confirms. At certain points, price movement becomes social. Charts go viral. Attention attracts capital. Capital drives price. This is how vertical moves happen. Holding through volatility is difficult. Emotional discipline is required. Price swings test conviction. Screens flash green and red. Decisions feel urgent. The mistake many make is trading scarcity for liquidity, selling a hard asset for cash during instability. This often leads to regret. Cash is abundant. Assets are not. Counterparty risk also matters. Paper claims depend on institutions. Physical ownership depends only on possession. During stress, this distinction becomes critical. Force majeure clauses, cash settlement risks, trading suspensions. These are not theoretical. They are written into contracts. Understanding what you truly own matters. In extreme cases, exchanges may close temporarily, prices freeze, but reality continues. Black markets form, street prices diverge, official numbers lose relevance. A closed market is not stability. It is confirmation of failure. Eventually, price resets higher. Governments may respond with policy, taxes, restrictions, regulations. History shows that when currencies weaken, alternatives are targeted. These measures create fear, but they also create premiums, underground markets, private transactions. Invisibility becomes valuable. Industrial demand does not disappear. Strategic needs override price concerns. Defense systems, energy infrastructure, technology supply chains. These do not stop because silver is expensive. In fact, fear of higher prices increases buying urgency. Inventory hoarding begins. Demand spikes, short term. Economics textbooks fail during crises. Human behavior takes over. Central banks face a dilemma: provide liquidity to stabilize institutions or protect currency value. Often they choose liquidity. Money supply expands. Asset prices respond. And this is the paradox. Attempts to control volatility fuel it. Watching the open becomes critical. Gaps reveal intent. Volume reveals conviction. High volume confirms stress. Low volume suggests manipulation. Correlations matter. Gold stability supports silver. Oil prices influence inflation expectations. Bond yields signal confidence. When all indicators align, ceilings disappear. Mining equities respond next. Mergers, acquisitions. Reserve replacement becomes urgent. Developers become targets. Valuations reset. This is where exponential returns appear, but so does risk. The most important rule during these periods is patience. Overtrading destroys positions. Fear and greed alternate rapidly. Long-term holders focus on purchasing power, not price. Assets measured against assets tell the real story. Homes, stocks, energy. Ratios matter more than numbers. Media pressure increases as prices rise. Blame narratives appear. Moral arguments surface. Holders are criticized. Ignore the noise. Markets correct imbalances. Debt expands. Resources deplete. Prices adjust. This is not speculation. It is math. This period will be studied. Charts will be archived. Decisions will be analyzed. Most will wish they acted earlier. Volatility feels uncomfortable, but it is the engine of change. What matters now is understanding, not panic, not euphoria, awareness. The system is adjusting. Paper promises are being questioned. Physical reality is asserting itself. Whatever happens next, the landscape has shifted. This was not just a price move, it was a signal. The calm before the open is deceptive. When markets return, reactions will be fast. Gaps will form. Liquidity will be thin. Emotions will be high. Preparation matters. Know your exposure. Know your risks. Know what you own. History does not repeat exactly, but it rhymes. And right now, the rhyme is loud. The era of easy suppression is ending. The era of real price discovery is beginning. And what comes next will not be smooth, but it will be honest. And honesty in markets is always expensive.